Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to this special series on life goals brought to you by Money Simplified, your guide to money and mutual funds. We are glad to have you with us for the 5th session on tax planning, and that is tax implications on mutual funds. In the last few sessions of Money Simplified, we talked about how mutual funds can be an effective investment avenue for aggressive investors looking to kill two birds with one stone: tax planning and wealth creation. We explained the various tax-saving investment products available to you via the mutual fund route. Moving forward in this session of the tax planning series, we'll explain the tax implications of investing in mutual funds. Yes, every investment avenue you select for tax saving has tax implications. Therefore, it becomes imperative to recognize the tax implications to calculate the net returns, that is, after adjusting for tax. So in this session, let us understand the tax implications on mutual funds. First, let's understand the factors involved in deciding the taxability of mutual funds. The taxability would depend on, number one, the type of mutual fund scheme held, whether it is an equity-oriented fund, that is those holding over 65% of the investable corpus in Indian equities, or other than equity-oriented funds, that is those holding less than or equal to 65% of the investable corpus in Indian equities, mainly debt funds or liquid or money market mutual funds or gold funds or fund of funds. Then comes the type of income earned from mutual funds, dividends and capital gains. Dividends. If you as an investor have opted for the dividend option and are in receipt of dividend income from mutual fund schemes, it is tax-free under the Section 1035 of the Income Tax Act 1961. However, there is a dividend distribution tax or DDT which is deducted at source for other than equity-oriented mutual funds. DDT is nil in case of equity-oriented funds. Capital gains will be subject to tax based on the period of holding, that is whether long-term or short-term. Long-term capital gains. Capital gains are classified as long-term when the period of holding is more than 12 months in case of equity-oriented mutual fund schemes and more than 36 months in case of other than equity-oriented mutual fund schemes. Short-term capital gains are those when the period of holding is 12 months or less in case of equity-oriented mutual fund schemes and 36 months or less for other than equity-oriented mutual fund schemes. Likewise, one's tax status is also an important determinant, that is whether it's a resident individual, Hindu undivided family, partnership firm, association of person or body of individuals, domestic company or NRI. You will recognize how in the ensuing part of this session. Now let us see the tax implications on equity-oriented mutual funds. When you opt for the dividend income while investing in equity-oriented mutual funds, the dividend received is exempt from tax. That is, dividend income is tax-free in the hands of the investor for all types of investors. Moreover, there is no dividend distribution tax on the dividend distributed in case of equity-oriented mutual funds. Now coming to capital gains. As you can see in the table, there is no long-term capital gains tax on equity-oriented mutual fund schemes, but only short-term capital gains tax. Securities transaction tax or STT is at the rate of 0.001% or 0.025% will be deducted on equity funds at the time of redemption, that is sale of units or switch to the other schemes. For individuals and HUFs, the surcharge is 15% but applicable only if the income in the financial year exceeds Rs 1 crore. Additionally, education cess and secondary and higher education cess of 3% is applicable on the total amount of tax plus surcharge. For unit holders who are domestic companies, no surcharge is levied where the income is equal to or less than 1 crore. However, education cess and secondary and higher education cess of 3% is applicable on the total amount of tax. Surcharge at the rate of 7% where the income exceeds Rs 1 crore but does not exceed Rs 10 crore. Additionally, education cess and secondary and higher education cess of 3% is applicable on the total amount of tax plus surcharge. surcharge at the rate of 12% where the income exceeds rupees 10 crore. Additionally, education cess and secondary and higher education cess of 3% is applicable on the total amount of tax plus surcharge. Now let's come to the tax implication on other than equity-oriented mutual funds. As you can see in the table here, dividend income received from other than equity-oriented mutual funds is also exempt from tax irrespective of one's tax status. But there's a dividend distribution tax that is deducted for other than equity-oriented mutual fund scheme while they distribute dividends. It is 25% plus 12% surcharge on tax plus 3% education cess and secondary and higher education cess on tax and surcharge for resident individuals and ETFs. Now coming to capital gains. As you can see in the table here, for other than equity-oriented mutual fund schemes, long-term capital gains tax is levied at the rate of 20% with indexation for resident individuals, excluding applicable surcharge and cess. Important points to remember. Before investing and redeeming your money from mutual funds, consider the tax implications because every investment avenue has tax implications. Recognize the factors involved. The tax implication in case of mutual funds would depend on the type of scheme, whether equity or other than equity, the income earned from mutual funds, that is dividend and or capital gains, period of holding, whether short-term or long-term, and one's tax status, that is whether one is a resident individual, HUF, partnership firm, association of persons, body of individual, domestic company, or a NRI. Dividend received is exempt from tax in the hands of the investor, both in case of equity-oriented funds and other than equity-oriented funds, except that the latter are subject to dividend distribution tax. In case of equity-oriented mutual funds, there is no tax on long-term capital gains if the investment held for more than 12 months. In case of other than equity-oriented funds, long-term capital gains tax would be applicable if the holding period is more than 36 months. So to end our learning exercise today, we now invite you to test your learning by taking the simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.